Hello friends, hope you're having a wonderful day. This is Jake. In the last video, I promised that I'll show you how I close my covered call and open a new one for the following week. So the stock I'm going to be using is JP Morgan. I've had this stock for quite some time. And if you look at the average cost, it's only $92.30. And I've sold more than $20 worth of premium against the same set of stocks. So I have 500 JP Morgan available for me to sell contract against. So I'll be doing that today. So let's go ahead with it, shall we? So as a summary, what I'm showing is closing a covered call and in the same trade selling a new covered call for the following week. So let's do that. So I have to click on the trade JP Morgan options. So the one I have is 5 contracts at 102 strike price. So of course I'll be buying that back. This would have expired tomorrow. There's only $2 premium remaining, so I should be buying it back. And then open a new trade for next week, which is October 2nd. So that'd be a sell call, right? And let's hit, I didn't select the strike price that I want to sell. So the strike price that I'll be going with is, let's see, maximum bang for the buck. I don't want too much money because I feel like JP Morgan can climb back to where it came down from. It came down from like around $100-ish. So I'll be selling it at 35 bucks for a 99.5 strike price, which has an 88 probability, 88% chance of being out of the money. So I'll do that, and I have 5, so I'll get $170 premium. So that's what I do. I collect premium slow and steady every week. Normally make like $300-400 from it, but this week I'm kind of trying to play it safe because the stock just came down, right? So it can bounce back to that previous price of $100. But if it's steady at $94 or $95 for 2 or 3 weeks, then I'll be more comfortable selling it at a strike price of 98 or even 97. So until that point is reached, I wouldn't be doing that. So let's go ahead with this trade. See, the stock price is actually increasing. It's at $94 now, so that's good. Maybe I should be entering a strike price. I'll enter the strike price of 45 because it looks like it's going up, so I'll keep it at let's make it even. When the trade executes, it's going to be good. So review my order, and let's submit. So if you look here, I'm buying back my 102 strike price, buy to close, and then I'm selling a new one for the strike price of 99.5 with the assumption that it's not going to hit 99.5 until next Friday. And then I'm going to sell it open. It's going to be an open contract. All right, hit submit. And more than likely this is going to be executed soon. It will be shown in the messages. So if you look here, I haven't shown the contract yet. All right, so hasn't executed yet. So once it executes, we'll have 200 bucks in our account, and that's what you do to buy back a contract for the week, which was a covered call, and then sell it for the following week. This is what we should be doing. All right, hope you enjoyed this video. If you would like more content like this, please let me know. Hope you have a wonderful day. Ciao.